Folks, over the last 3 months or so, you have heard the word tariff, inflation, probably 1,000 times. But I got to tell you, I think there is something bubbling below the surface that could potentially be even more impactful, more negative, and a bigger problem than tariffs. And that is the inflation that we might be seeing in the services sector, thanks to the PPI reading and some other indications. Taylor, how you doing, buddy?
Doing great. I'm interested to see where you're taking this because I'm not sure I know where this is coming, but you give it to me and I'll react accordingly as I see things.
I love that. I love that. So obviously we both know, and we've talked about the PPI reading last week was beyond disgusting, right? 0.9 month on month, 3.3 or whatever it was, way above expectations on all fronts. What I saw most talking heads and most novice folks talk about is tariff inflation is showing up. Now, if you happen to be an economist like myself and have the ability to go into the details, you'll actually know that, yes, there was some tariff inflation, toys, furniture, but nothing crazy. In fact, 75% of this disgusting number was not in goods. It was in services. And as you know, but for the audience, the largest input to services is wages. So I believe the boogeyman, the real scary character in this is not tariff inflation, because again, it's 1/12 or 1/10 of our economy, goods that are imported. But if you have an economy that is service-based and we are suddenly seeing service inflation, hold your hat. This could be a problem. So that's where I'm going. I think this is the bigger story that no one's talking about.
This is why you're the best. You've been talking about this now for, a few months in a row. And there are a lot of underlying factors that are at hand here. I mean, everything from a labor perspective is supply and demand.
Yeah.
And we know that you've had a supply shock in the negative direction. And that all comes upon the changes that we've made in immigration and moving folks back out of the country, et cetera. Deportation was the word I was looking for and couldn't think of. But it's a supply demand game. And if the supply is meaningfully changed, that supply dynamic, shocks the market at some point. And these are slow, gradual builds. And this is the first real indicator that we've seen where it started to look nasty.
Yeah, because when you step back and you think about services and AKA wages, you can go back to Biden's decision to open the border as one of the reasons that wage inflation did not keep up with goods inflation, right? Inflation peaked out at 9.1%, as I recall. A lot of that was goods inflation. Now, a lot of that was supply shock and, all of those things. But artificially, what we saw for years is wage inflation was below inflation, which means in real terms, you're going freaking backwards. That is not good for the U.S. household. Now, historically speaking, as an economist, what we like to see is total inflation about 2% and wage inflation 3%. Those are rough models. What we saw under the Biden administration or COVID or however you want to frame it is we had negative, right? The real wages went backwards. I believe what we're seeing now, and it's early, but this is real potential, is we're going to see that makeup. Because again, to your point, where we're having a labor shock now on one way, before it was the other way. We had more people coming in, absorbing jobs, doing work, keeping wages suppressed. Now the supply is changing, the story is changing, and wages are going up. And this could get really sticky. If we see kind of this feedback loop of wages inside services, we could see inflation go back to 4 or 5% pretty easily, I think.
Yeah. And let me be clear on something. When we talk about immigration, this is not a political thing. We all know there is good immigration and bad immigration. There's good and bad, right? And so we need to make a clear line of delineation if we are going to allow folks to come back into this country, the difference and what our criteria for the difference is. And then figure out a plan and stick to it. But I also think it goes back to what was going on in the economic backdrop coming out of COVID, because what you had was mass stimulus hitting, but it wasn't hitting in the way of a traditional paycheck. It was hitting in the way of helicopter money, whether it was you had checks. The biggest part of the stimulation was just the COVID checks, the semi checks that were just literally going to people's pockets. And that doesn't come through wage inflation. That comes into their pocket and then it gets spent driving inflation on the other side. So the wage pressure wasn't necessarily there from a wage inflation perspective.
Yeah, I totally agree. And again, I think most of the media is missing it because, this tariff inflation, again, in my opinion, is going to be less than the talking heads kind of highlight. They all want to kind of make it a 1-to-1 ratio. And I think it's really clear to see that, yes, consumers will pay more, but guess what? Margins on the creator will go down. Margins on the distributor will go down. We'll see demand destruction. We'll see switching, all of these things that are very economic driven. It's just not going to show up as the big scary thing. However, services inflation, that might be 2 or 3x bigger and more impactful, and no one's talking about it.
Well, your point is super well put. And the fact that, yes, there is going to be some bleed through inflation, but it's only 15% of goods imported, right? So it's not only are we not going to see the 1-to-1 move, we're going to see a fraction of the 1-to-1 move on a fraction of the things that are purchased. And that's just on the goods side, right? So to your point, the services is vastly more important. And it's what really we thought was improving in a meaningful way earlier on this year. We thought that services inflation was coming down dramatically. And dramatically is not fair, but we thought it was coming down precipitously. I'll put it that way.
Yeah, I would argue it looked for a while that it was truly disinflation, right? It wasn't true deflation, but certainly disinflation. So the rate of change was going down. Now, again, it's only one data point, but again, I don't think anybody's talking about it. This, let's just pretend for a moment. Just pretend. Earlier, we talked about Jerome Powell and Jackson Hole. Let's just pretend for a moment he opens the door to a September rate cut. Let's even go this far and say a September 1/4 point rate cut happens. Let's just play this out. But we get 2 more negative service, scores on inflation. That could cause the Fed not only to stop, but raise rates. Think about that thing.
Oh, you want to see that man in Washington, D.C. lose his mind if we get a rate hike along the way. This is why I think that Friday, and we did a prior video on this, but at Jackson Hole, I think this is why Powell does not draw a hard line in the sand one way, shape, or form, because there's just too much outstanding data, and the noise in the data right now is of epic proportions, coming in highly volatile, coming in highly subject to whomever's at the BLS, whomever's here, whomever's there. And there's so much unknown right now that I don't think that he can put that staunch line on things, because if you were to cut and then all of a sudden you're Arthur Burns and then you try to become Paul Volcker on the next blink of an eye, yeah.
Yeah, I mean, that's the worst case scenario. The Fed can't look reactionary and then wrong. I mean, that just voices for the no cut in September, right? If that's really a concern. So, yeah, again, I think the line in the sand, one of the things I like to do is collect receipts. I'm putting this video out on purpose right now because I don't hear anybody talking about services inflation. I think this is the big boogeyman out there that might scare us in a very near future, meaning the next 30 to 60 days. So I'm glad I'm going to have these as receipts because, dude, no one's talking about it, and it could be nasty. It could really cause the Fed to raise rates. It really could.
Yeah. No, and you're right. No one is talking about this, which is why we came into this video, and I'm like, please tell me what you're talking about because because I'm not hearing it anywhere else. But services are the most important piece of the economy. Labor is the most important piece of the broader economic backdrop. Services is 70% of our economic output. Labor is what drives it. And if we start to get movement in underlying wages, it bleeds through and it can get, scary.
Taylor, where can people find you?
Yeah, find us at Life Goal Investments. We're on both Instagram and TikTok.
Folks, he does this amazing thing on Instagram. I'm sure TikTok, I don't look at TikTok, but I'm just going to assume he does. 60-second clips. Yeah, 60-second clips that feel like 5 minutes. Give him a watch. Thanks, buddy.
Thanks so much.